All right, Fox on top of two storms and, well, barreling through and hitting investors, and in the panhandle, hitting just average folks who probably weren't too concerned about the right end of your screen. Welcome, everybody. I'm Neil Cavuto, and it has been an awful day weather-wise in the Gulf and an awful day at the corner of Wall and Broad and for your 401k and investment statements. We are on top of each development. The situation with that hurricane, and it's a doozy. Michael had a Category 4, doing a lot of flooding. There's a lot of wind. There's been reports of a good deal of damage, but it could have been a whole lot worse. I wish I could say the same about what happened in the investment community today. We're on top of both dramatic developments. By the way, I do want to kick off, though, with what happened on the financial side and what could possibly bring us to session lows down better than 3%, the worst single-day performance in this market. You'd have to go back to early February, and you'd have to go back to levels in this market that we have not seen since all the way back in August. So do want to step back from all of this. And as bad as it was, we are simply revisiting, in cases of some stocks, levels we were last seeing about 4 to 6 weeks ago. We'll get into the details on that. But let me suffice it to say that the catalyst for all of this was an improving economy. Now, I know that sounds a little weird, but a lot of this has to do with a backup in interest rates to address that improving economy and the notion that interest rates are going to have to go back still further and higher. What happens with the markets is they never really know how to digest the unexpected or the unknown, and the unknown for them is how much is too much. Right now, a 10-year note fetches about 3.25%. That is the highest we have seen in about 7 years. A 2-year note reaching a level today that was the highest we've seen in more than a decade. But it's what you get used to. There were times when these were double-digit events. In other words, when we had a 10-year note at 10% or better during the late 1980s, or when we had a 2-year note that was routinely double what it is now. For a while, triple what it is now. But it doesn't do much good to say that was then, this is now. It's what we've been getting used to now. Better than a decade of near 0% interest rates set by a Federal Reserve that was trying to get us out of a recession and a meltdown. It did the trick. Now the trick is unwinding all of that. Again, easier said than done. To Charles Payne of the NASDAQ, that was the not-so-pleasant beneficiary of the bulk of that selling. So, Charles, interesting enough, a lot of those tech names that led us on this parade were the ones getting the most battered, huh?
No, you're absolutely right, Neil. And it's not just today. These big tech names over the last 2 or 3 weeks have been conspicuously weak, very vulnerable, some going back to earnings. Facebook collapsed on its earnings. Netflix didn't have great earnings. Twitter came down. But then some of the more, even the larger names. Apple 2 days ago got a sell rating. That's really rare with a company like that. Amazon has its issues. A lot of this revolving around regulatory concerns as well, which have creeped into this area because of some of the practices from all of them. But, you know, no one, to your point, was spared. And I'll go back to the Dow for a moment because what we witnessed now this year are the 3 biggest, largest point losses in the history of the Dow. Not percentage losses, of course. 3 of the 4 biggest losses, of course, this year all revolved, in fact, no, 4 of the 5 all revolved around the Federal Reserve. In February, rates started to go higher. We got a jobs report that looked like it was too hot. Everyone started to panic over what the Fed may do to slow this economy down. That sort of settled down. We were able to deal with 3%, but not a velocity of how quickly these rates have gone up again, these yields. Again, spooking the market. But I will add, Neil, there was some fundamental news. You and I talked a little bit yesterday. It's not a household name, but Pittsburgh Plate and Glass is a 135-year-old company. People know the company. You probably have some of their paint on your car. Okay, so they had bad numbers. They warned of higher prices. Today, Fastenal, again, an industrial name, not a household name, but it led the industrials lower. That was the second worst performing sector. It was the worst performing stock in that sector. So some of this is interest rate related. Some of this is a higher price. And some of it is just speculation that, you know, things have been great. Can they continue?
All right, Charles, thank you very, very much.